Hello, mentors. This is part two of the three-part video series on supply and demand. Part one, we went over our watch list, our market segment, our timing, and our patience. Let's begin part two. Part two is mostly going to be over what we're going to be looking for, and then part three is we're actually going to dive into charting and get down to, you know, all what we learned on part two. But number one, keep it simple. You're going to have very minimal indicators. Most of the indicators I do use are going to be help me with conviction on getting into a play. They're not going to be a reason I get into a play. Most of them are going to be based on volume, which is real time. Unlike probably 90% of the indicators are going to be lagging and kind of delayed. But we're going to go over our rally-based rally, our drop-based drop, our drop-based rally, rally-based drop. We're also going to go over our fair market gaps, breaker structures, and liquidity grabs. So keep it simple. There's no need to have multiple indicators. Most of them are going to be volume-based indicators, and you're going to be, set your alerts. Alerts going to definitely help you, gauge, oh, a price has come to a certain time, a stock has come to a certain price, and I'm going to start looking into that stock. It's not going to be based on a line, it's going to be based on actually the price. So we're going to begin. There's four things I look for in supply and demand. The first one's going to be a rally-based rally, where you have you start a formation of a demand zone. So you're going to have a big move to the upside, and then you're going to have, which to begin, the market is either in a balance state or an imbalanced state. A balanced state is where you're going to have buyers and sellers agree on price. Buyers and sellers are going to both be present. And then your price imbalance is going to be where sellers take over. It's going to be all selling pressure, a lot of red. So you're gonna have your move to the upside. You're gonna have followed by your basing candle down here, then another move to the upside. So what you're looking for is that basing candle. What I do is take it from the open of the basing candle, or basically, sometimes this can be a green candle, but most of the time it's going to be red because you have your move to the upside, sort of your consolidation where they agree on price, and the buyers come in again and take it to the upside. So when you draw this, you're going to take your kind of the top part of the body all the way to the bottom of the wicks. Sometimes this wick will be lower, and so I'll take the bottom of either wick. You're going to have your drop base drop, which I just put on here and it's not showing, but you're going to have move to the downside, followed by a basing candle, followed by another move to the downside. And part three, I'm going to go over this in detail. These are just kind of just showing you what we're going to be looking for. In part three, we're going to definitely dive into each stocks and figure out and try to identify these. Rally based drop, which is going to have formation of a supply zone up here, which is your supply zone. You're going to have a move to the upside. Then you're going to have a basing candle here, and then you're going to have a strong move to the downside. So your supply zone is going to be the bottom part of the body to the top of the wicks, either this wick or this wick, and that's going to be your supply zone. And you're going to wait, draw that out, and you're going to wait for a price to come back into it. Supply and demand. We're going to go into detail what exactly the basis behind supply and demand when we actually watch charts live and chart everything out. The last one, you have a drop based rally, which you have a huge drop to the downside. This could either be green or red, and then you have a huge move to the upside. So you're going to have a basing candle price balance, and then you're going to have a move to the upside. So this is going to be your demand zone, bottom of the wicks to the top of the body. Value gaps is kind of a new concept I'm trying to include in supply and demand. It's going to be a liquidity void that has price efficiency, only contains one participant. You're either going to have a buyer or a seller. and then you're going to fill in the remaining participants at a later time, and you're kind of want them to fill in 50%. And the way I explain this the best is the market doesn't want, especially on ES, SPY, QQQ, the market wants to be balanced. It's best for banks, best for the economy, best for the government, best for everybody, for the market to be in a complete balanced state where buyers and sellers, are at the same price. But right here, you can tell we have a kind of a move. We have a huge move to the downside. This is all selling right here from this wick all the way to the next candle wick. So this is going to be your fair market, your fair value gap. So you're looking for it to come back up to about 50% and then see if sellers actually want to take it back in. So they're feeling this huge selling pressure, selling imbalance. They're going to fill it up with buying. And then let's see where it goes from there. I like using these a lot on kind of lower time frames because you could, most stocks, your supply is going to be up here. Sometimes your stock doesn't come back up to the supply. Well, I'll show that a lot in charting where, your alerts you kind of have to set them below where they actually have to be because you don't actually make it all the way up to the supply, and hit it and get into the supply. Sometimes you're kind of, sellers come in a little bit earlier. So that's why you got to kind of look at fair value gaps where you have this huge selling pressure. You take it from this candle bottom wick to this candle. So all in this box right here, that's going to be your value gap. This is all selling pressure. Eventually the market wants to come back up and fill it in with buying pressure. So it's back to a balance. Also, you have a breaker structure, which does help with supply and demand. You want to, and I'll go over this on part 3, but your price break and trend of the market stock price, you got higher highs, lower lows, and you also have the ABCD formation, which is a part of supply and demand and the wave theory. But the main thing I like to do on supply and demand, like your demand's going to be down here. If you want to have a strong high, you want this high to break this previous high. That means your demand's very strong. So when we eventually get back down to the demand down here, it's going to be a pretty nice bounce because you can tell buyers came in strong because we're able to take over these sellers. This structure right here where previously sellers didn't want to get past. So if we're strong enough to take out here, when we get back and we have still people who want to buy down here, we're going to be able to bounce off that demand and take it back up. And then you also have liquidity grabs that big traders and institutional investors who need to fill big orders must find liquidity areas in the market to complete their trade. Stops are often considered to be critical for survival in a leveraged market, and what I like to call is a fake breakout. This is where I'm really not like playing the breakout at all because you do have a lot of fake outs. And it's basically right here, your liquidity area, where they want people who want to use, you know, they're going to play the breakout above this liquidity area. And they're playing this breakout, oh, wait, we're making higher highs, we're making higher lows. We're going to eventually break out. But what the market makers do is they fake the breakout and drive the price way down. And they're stopping everybody out, getting liquidity. They're able to fill their orders. The more liquidity there is, they gotta they gotta fill their orders too. So you're always looking for a price up. I'll show this a lot in the market on what we're looking for on this liquidity grab and this kind of breaker structure. Quick pop up. They fake the breakout and then drop the price. And that's going to end part 2. Part 3 is going to be all in charts right here. You can tell right here we're just going to be nailing charts. It's going to be the longest part, definitely the most important part on supply and demand is just practice, practice, practice. But this does conclude part 2.